Welcome back to the Deep Dive. Today, our mission is, well, pretty focused. We're looking right at the crossroads of institutional crypto adoption and public responsibility.
That's right.
We're diving into a legislative proposal coming out of the U.S., specifically Florida, that could actually allow public pension funds to invest directly in digital assets.
Yeah, and this is potentially a landmark moment. It really forces the question, doesn't it? At what point does an asset class, especially one known for volatility, become foundational enough for a state to consider putting retirement funds into it?
Right?
The sources we've looked at suggest we might be getting close to that point, maybe faster than some thought.
Okay, so let's unpack this. We are talking about Florida specifically. There's a proposal on the table right now, and the aim is to create the legal framework, the actual rules for state pension funds to hold crypto.
Yeah.
And this isn't just market talk, is it? This is about real money. Taxpayer-backed funds meant for teachers, police, firefighters, their retirement security.
Exactly. And the sources really highlight the key detail that's got everyone's attention.
Right.
If this bill passes, it would authorize the state's chief financial officer, the CFO, and the pension boards to allocate up to 10%.
Wow, 10%.
Up to 10% of state and pension fund assets into Bitcoin and, importantly, regulated crypto ETFs.
10% feels like a really high ceiling, especially for a first step into a new asset class like this. And with public funds, too, do the sources give any indication why they're setting the bar potentially that high from the start?
Well, it seems to tie back to the state's financial leadership. Florida's CFO, Jimmy Patronis. He's apparently had a history of advocating for Bitcoin inclusion in state retirement funds for a while now.
Okay, so there's some background there.
Exactly. This proposal looks like the formal legislative step to make that happen. It reflects a long-standing interest in diversifying into digital assets, so you have to see it as maybe partly a political priority as well as just a financial strategy.
Got it. And just to be super clear for everyone listening, this isn't saying they have to sell stocks or bonds to buy crypto, right? It's not a forced swap.
No, that's a crucial point. It's absolutely not a mandate. It's framed as an expansion of the investment menu.
Okay.
It gives them the legal authority, which they currently lack, to actually hold these digital assets and ETFs in their portfolios. But, and this is key, only if their own fiduciary boards approve it, following strict risk assessments. It basically removes a major legal roadblock.
Right, removes the constraint. Okay, let's pivot a bit then. Let's talk about the why, because this feels bigger than just one state's legislative agenda. What's the signal this sends, potentially, globally?
Oh, the signal is potentially huge. Think about it. If a major U.S. state successfully puts rules in place for its public pension funds to own crypto, that provides a massive dose of institutional validation. It suggests that at a government level, these assets are starting to be viewed as mature enough or legitimate enough to sit alongside traditional things like treasury bonds or blue chip stocks.
But is that validation truly institutional in the broad sense, or is it maybe more specific to Florida's, let's say, more crypto-friendly political climate?
Yeah.
We know some states are definitely warmer towards crypto than others.
That's a fair question, a necessary check. And yes, Florida certainly seems to have a receptive environment politically.
Right.
But the mechanism itself, pension fund investment that's universally seen as conservative. Pension funds, by definition, manage enormous sums, hundreds of billions. They're patient capital.
Deep pockets.
Very deep pockets. Even if these boards decide to allocate just, say, 1% initially, not the full 10%, that could still mean billions in new, stable capital flowing into the crypto market. That kind of scale starts to transcend local politics, I think.
Okay. And this is where it could get really interesting then. The precedent it sets. This isn't just about Florida retirees anymore, is it? It could be a template.
Exactly. This could absolutely serve as a model for how other states or even other countries eventually approach this. If Florida manages to implement clear, workable rules for things like custody, valuation, public accountability.
All the tricky stuff.
All the really tricky stuff needed for public money, yeah. If they create a proven framework, then other states that maybe have been interested but hesitant because of legal gray areas, they could potentially adopt or adapt that Florida model.
So a potential domino effect.
Could be, potentially setting off a chain reaction that legitimizes crypto ownership for public funds much more broadly.
That really paints the picture for the potential upside, the validation argument. But we have to balance this. Whenever we talk about public money, taxpayer money, funds guaranteeing retirement payouts, that fiduciary responsibility is just incredibly high.
Exponentially higher, yeah.
So we need to look at the other side. What are the specific risks that the sources are flagging here?
And this is really the core tension, isn't it? Pension trustees are under immense pressure, legally and publicly. When they look at something like this proposal, they have to balance any potential diversification benefit against some very, very serious risks. Our sources outline about 5 major challenges they need to wrestle with.
Okay, let's tick through them. Starting with the obvious one, I guess.
Right.
Volatility.
Volatility is number one, absolutely. Crypto markets are just fundamentally more volatile, orders of magnitude more volatile sometimes than the traditional assets pensions usually hold.
Right.
If there's a major long downturn in crypto, that sharp drop in asset value could put serious stress on the fund's ability to meet its future promises to retirees. You could be looking at a political nightmare, let alone a financial one, if a pension fund suddenly looks like it might not meet its obligations.
Yeah, that's huge. And then there's the regulatory aspect. With everything still swirling around D.C., that uncertainty must be a massive headache for long-term planning.
It's a huge obstacle. Fiduciaries have to factor in the risk that federal policy could just shift dramatically. What if Congress or the SEC suddenly reclassifies an asset that the fund holds?
Or restricts trading.
Exactly. The fund might be forced to sell off a large position quickly, maybe at a loss. They'd be investing public money into an arena where the legal goalposts are demonstrably still moving. That's a tough sell for a conservative board.
Definitely. And beyond the money and the rules, they also have the court of public opinion to worry about, don't they?
Absolutely. You can already hear the critics, right? Arguing that using public retirement money for crypto is just too speculative. It's like gambling with taxpayer funds.
Yeah.
That creates political risk for whoever approves it, the CFO, the governor, especially if that crypto allocation underperforms later. Plus, there are practical operational hurdles. Getting reliable public-grade valuations, ensuring top-tier custody security, transparent audits. These are non-negotiables when you're dealing with public funds. It's complex.
Which connects to that fifth risk, I think, related to the sheer size these funds manage.
Yeah.
Liquidity. The problem of getting out if you need to.
Yes, exactly. If a public fund holds a really big chunk of a particular crypto asset and suddenly needs to sell, maybe to cover unexpected payouts, especially during a market crash, that huge sell order itself could tank the price even further, making their losses worse. This market-moving exit risk is a very real worry for managers handling billions. It forces them into really complex risk management strategies.
Okay, that lays out the tightrope walk pretty clearly. So if we pull back again, connect these risks in the proposal itself to the bigger picture.
Yeah.
What does the mere existence of this kind of legislation tell us about where digital assets might be heading long-term?
I think it underscores a pretty fundamental shift. Crypto seems to be transitioning, maybe slowly, but transitioning from being this, exotic fringe holding to something being seriously considered for core portfolio allocation. And not just by hedge funds, but by the world's most traditional, most conservative institutions like state pension funds. This whole proposal, whether it passes or not in this exact form, it supports the idea that the assets likely to survive and really thrive over the next, say, 50 years will be the ones that gain that institutional legitimacy and broad regulatory acceptance.
Okay, so for the listener, maybe someone building in this space or an investor watching closely, what are the immediate practical takeaways from this potential shift if this trend continues?
Well, the overall signal is pretty bullish for long-term legitimacy and capital inflow, obviously. But practically speaking, it suggests a huge, potentially imminent demand for new infrastructure.
How so?
If public funds are genuinely starting to enter this market, they're going to demand absolutely bulletproof, institutional-grade crypto services. We're talking enhanced compliance tools, certified audit frameworks, rock-solid custody, reliable insurance. The whole support system needs to scale up significantly to handle this kind of conservative capital properly.
Right, the standards are just different. And for people already holding crypto assets, does this mean new players in the market? Competition?
That's a really key point. As the pool of what are considered legitimate, regulated digital assets potentially grows, you could increasingly see these deep-pocketed, patient public funds competing directly with private capital, with VCs, with hedge funds for allocations in certain assets. That could definitely impact prices or validate specific parts of the market.
So as this sort of situation unfolds, and potentially others like it, what are the specific signals, the metrics that people listening should really keep an eye on?
Okay, several things. First, the obvious one. Does the bill actually pass? But maybe more importantly, watch the final rules if it does. What's the exact percentage ceiling they land on?
Right. Is it really 10% or something lower?
Precisely. And which specific assets are allowed? Is it strictly Bitcoin and maybe some specific ETFs? Or does the door open even a crack for other established assets like, say, Ethereum? Or maybe even certain types of stablecoins? That detail matters.
Okay. What else?
Second, try to track how the pension fund boards actually justify any allocations they do make. Look for public documents or statements detailing their risk management frameworks, their stress tests. How are they explaining this to their beneficiaries and the public?
That's the accountability piece.
Exactly. And finally, watch for momentum. Does another major state, maybe a Texas or Virginia, someone like that, start seriously debating a similar proposal? If that happens, then you know this is likely a genuine institutional trend starting to form, not just an isolated Florida initiative.
This whole deep dive really highlights that core tension, doesn't it? On one hand, you have this potential for massive institutional validation, state-level acceptance. On the other, these incredibly significant non-negotiable risks that come with managing public retirement money.
It really does, and it kind of forces you to step back and just think. If state pension funds, the epitome of long-term, stable fiduciary responsibility, if they actually start holding Bitcoin or other digital assets as part of their core strategy, how much does that fundamentally change the entire narrative around crypto's maturity? Does it start to transform it from just a speculative asset into something seen as a core, maybe even multi-generational store of value? That's a huge question and a crucial development to keep watching.
It absolutely is, and thank you for guiding us through all that complexity. Now, for everyone listening, if this kind of breakdown, taking these dense sources and pulling out the key insights you need, if this is helpful for you,
We'd hope it is.
then we genuinely need your support to keep doing it. Seriously, taking a second to hit the like button, maybe leaving a comment on what stood out to you, and definitely subscribing and hitting that notification bell. It truly does help the channel grow. It boosts our visibility in the algorithm, and that lets us keep creating this kind of in-depth crypto content for you.
It makes a real difference.
It really does. So thank you for that, and we'll see you for the next deep dive.